And what I'm primarily here to talk to you about this morning was an internalisation proposal where GARDA Diversified Property Fund has proposed to acquire GARDA Capital Group entirely via a scheme of arrangement. So I'll talk a little bit more about those things, and I'll just flick through some of these slides from the historic presentation from a few weeks ago. I think the very first thing to say in terms of the internalisation proposal is the governance around that transaction saw the board of GARDA split into two respective subcommittees, and each of those subcommittees have 100% or unanimously supported the proposal from each side of that transaction. More importantly, the independent experts operating for both GDF and GCM have also provided an opinion that says it's fair and reasonable and therefore in the best interests. I'll run through this presentation from a few weeks ago and try and provide a bit more detail across the board. I'll just stick on this slide for starters, and GARDA Diversified Property Fund did list back in July 2015, and GCM listed in 2016. This particular slide gives you some indication of the growth in scale and the nature of change of the GARDA Diversified Fund over that time. We started IPO with about 140 million in assets and a little under $100 million market cap. And after the acquisition the other week, we now have about $405 million of assets and about a $270 million market cap. Fiona touched on project pipeline. We're one of the few REITs, particularly at our scale, that has a very active approach to developing our own product to keep. We're not a developer to sell, but very much a developer of our own properties. So there's about another $50 million worth of projects here in Brisbane that are all industrial projects that we'll see delivered over the next 18 months as that portfolio stands today. The property acquisition was out at Thine Road, Morningside. It's a fantastic asset, as you can see. It butts right up against the residential there. It's about the closest industrial distribution facility you can find at the Brisbane CBD. It's less than 5 kilometres as the crow flies from the CBD to this particular location. A few minutes away from the Gateway Bridge and the various arterial highways running north-south and just as importantly out to the seaport as well. Acquired at about a 6.5% passing yield. What we liked about this asset was there's about 11,000 metre shed at the front. It's about 10 years old. We can expand that by about 6,000 metres, which will allow us to squeeze some more yield out of the acquisition. And a smaller 5,500 metre shed to the rear. It's about 30-year-old, but it's been completely rebuilt about 2 years ago. So the acquisition at the time was about a 3.5-year WALE and a 6.5% passing yield. The portfolio post-transaction, and a part thinking back to IPO, standing here today, we're about 55% commercial, 46% industrial. When we started, we're about 5% industrial. You'll see also there's about 36% to Melbourne, 39% to Brisbane, and some holdings across Cairns, Mackay, and the Gold Coast. The equity raising, as I said, the placement that occurred a few weeks ago was a $31.5 million equity raise at that point in time. As the placement was conducted rather than other forms of capital raise, simply because of the proposal to internalise made the story a little difficult to raise money in a broader sense. So the overview of the GARDA Property Group, which is what we'll hope will be known by at the conclusion of the transaction, simply is all of the assets that GARDA Diversified Property Fund has at the moment and the internalisation of its manager. GDF is the only fund that GCM currently manages, and so that's is a reasonably clean position as we come through. In terms of, I'm jumping around a little bit, but I'll come back to that. But in terms of process from here, as I said, there's a schemes of arrangement. We've been through our first court hearing some weeks ago. All of the booklets have now been dispatched to both GDF and GCM members respectively. Unfortunately, they should be clogging up your mailboxes or mailroom very soon if they haven't already. The first vote is for GDF. So the GARDA Diversified Fund will have a members meeting on Friday the 1st of November, so only the end of next week. And then GARDA Capital Group has its vote on the 15th of November, 2 weeks thereafter. So part of being here today is to encourage you to encourage your clients to have their say, whatever the say that might be, and to request them to participate via their proxy or their voting as we run through from there. In terms of the strategic rationale for the internalisation, financially compelling across the board. The transaction will result in no change to distributions, but about a 12.5% increase in the financial position. And what that relates to is that GARDA Capital Group currently gets paid revenue that relates to capital nature on the GDF side, so things such as leasing fees, development or project fees and the like. Of course, once the internalisation occurs, there will be no longer any fee leakage outside of the group, and these things will start to stay within the broader group. So the actual financial metrics is about a 12.5% accretive transaction, and we've reaffirmed distribution for the financial year. Of course, one of the largest things that occurs is the alignment of interests, albeit GARDA Capital Group's owned 14% of GDF to date. The alignment will see us, of course, being 100% all in the same bucket with the rest of our shareholders. Flowing from that, of course, is some management stability. We're all there. This is a transaction. It's a script-based transaction. There's no cash leakage out of this, and so people will continue to be doing what they did yesterday, tomorrow, but we'll all be in the same boat, going the same way. We believe it'll bring some enhanced growth opportunities and potentially some investor participation. So the majority of the REIT market is an internalised model. We happen to be externally managed to date, and that externally managed scenario comes about off the small scale that we started a few years ago. And we're probably one of the smallest REITs to internalise. Most internalisations you've typically seen at 2 to 3 times the scale of what we are. And there's plenty of REITs in the couple of $1 billion asset base that are still externally managed, such as the Centuria stable of listed REITs as well. So the internalisation proposal, I've touched on some of these things, and I won't spend too much time going through these. Just to reiterate that the terms agreed is effectively a 1.6 times merger metric. And so what we mean by that is for every 1 share that you held in GCM, you'll be offered 1.6 shares in GDF. And that effectively results at current trading at around a $2.30 share price for GCM. Important to note that the placement that occurred a few weeks ago was done at $1.40. We've continued to trade, I believe, about $1.46 to $1.47 range over the last couple of weeks. So it's been well supported. That placement, of course, was done to participants with the knowledge of the internalisation at that stage, and so we saw that as a great level of support by existing shareholders who've come to support that transaction. From here, it's really a case of getting our members to get involved and to have their say. So look, the other couple of things that come out of the transaction is gearing of the fund will stay around 37% as we stand today. We've mentioned we've got some projects that we're working through that will see that gearing rise over the next 6 or 9 months. Distributions reaffirmed at 9 cents for this particular financial year. As I've said earlier, it's about a $405 million going to $450 million portfolio, broadly equally balanced between industrial and commercial. That commercial exposure is largely Melbourne suburban commercial buildings, and the industrial exposure is largely here in Brisbane. WALE a bit over 5 years and about 17 assets. Market capitalisation upon merger should be about $330 odd million at current trading price.